We are microdosing macroeconomics with the acid capitalist himself, Hugh Hendry. Now, there are things that are known and there are things that are unknown with how money works, where it comes from, where it's going, inflation, deflation, and in between what's known and what's unknown lie the doors of perception. This is why it's so important to understand not only the mainstream voices in the financial world, but also listen a little bit more to what feels like the unhinged voices shouting to us from the corner. Hope you enjoyed this episode and you get a lot out of it. If you have, please share, like, subscribe, do all that good stuff. Let's get started. Are you holding a little dog there? Or is that a microphone?
How's the microphone? No, no.
Okay.
Are you just happy to see me? Um,
Indeed. Cool. Okay. Hugh Henry, the acid capitalist, thank you for joining me today.
um, absolute pleasure. Let's rock and roll.
Let's rock and roll indeed. Okay, now I have been bumping up against you every now and then on YouTube. I've been catching little whiffs of Hugh Henry, and some of your insights have kind of challenged my understanding, which is still growing, around how the global markets work, how financial institutions work overseas, and all that sort of stuff. So I want to start off with the Federal Reserve, and I think many people have views around the Federal Reserve that it is kind of like the puppet master, and that when it prints, markets go up. But are they really the puppet master, or are they just muppety bureaucrats? What's your view on the Fed?
Um, Muppety bureaucrats, I like that. And then your introduction, we were bumping up against each other. I thought we were going
Yeah,
into grinder world, but
I know. Well, it's your microphone, Hugh. It's really putting me off.
I can't win. So to answer your point, it's remarkable the high esteem that the Fed is held in by the very high upper echelons of U.S. money management. I had the pleasure over the weekend. I was catching up on some YouTube interviews with the joint CIOs at Bridgewater, and they have deference for the Fed. They really believe this is controlled by them. Um, Maybe they're right. I don't have a license on the answers, but I think the biggest challenge on that belief is, give us a good example of a noble adventure by the Federal Reserve, and an intervention set to recalibrate the rate of growth, in the fear that if it wasn't recalibrated, we'd have an inflation problem. My memory goes back at least 25, if not 35 years, and it's really hard. There was the, the Greenspan Fed, I think it was 1992, prematurely, or just at the right point, raised rates modestly, and the stock market went sideways. There were a couple of financial accidents, Orange County, there were a few defaults, but by and large, the Fed had taken the steam out of perhaps an overheating economy, and the next year the financial risk assets were off to the races. That's the
Yeah.
last time I kind of would argue they were the right side of history. Some might. I'm willing to contend that the intervention at the end of March 2009 um, was a break from a hard money rhetoric,
Mm.
that we're at a point where people forget it now, but Citigroup Travelers was the JP Morgan of its age. If we go back 15 years ago, largest financial behemoth, most respected. It was bankrupt. It was trading in cents on the dollar, and the Fed had a choice. The system had gone digital. It was either going to zero, it was breaking, or they had the chance to reset it and let it come back, and they chose the latter. Um, but they use the camouflage of language, I believe. They use this quantitative easing, and perhaps later we'll discuss that I have misgivings in terms of what that actually is. It just a groovy slogan? Does it actually infer money printing? Question mark.
Mm. Okay. Well, that is kind of like ultimately where I'm keen to go with that question. Actually, is does QE does that equal money printing? Does that equal asset price inflation, and therefore does that equal consumer price inflation? Like, is it again? Is it like a variation of that first question? Is it the Fed that is actually causing inflation, and can they actually control the dog, or is the tail just going to be wagged by the dog?
Yeah, and obviously it's complex, but let's have a go.
Yeah,
I think there are three components to it.
yeah,
Um, so the first component, the classic, the orthodox definition of money printing is a bank extending credit. You go, they grant you a mortgage,
yeah,
and they pass, I don't know, $3 million into your account, and it's digital money. It's a digital ledger that those dollars didn't exist before. They're in your account, and then you pass them on to the seller of the property.
yeah,
Quantitative easing um, is, I believe, seeking to um, encourage, foster, influence, make that decision
mm,
happen more often, so that it makes a difference. It does so in that, if we simplify it, there are three economic agents. There's the Fed. Um, there's me. I own a treasury, and there's my private bank. I sell the treasury security to the Federal Reserve, and immediately my the deposits at my bank are increased by the net sale proceeds. For the private sector bank, um, again, it runs. This is banking. This is finance. It's all about ledgers, T accounts. Um, the liability, which is to say, my deposits have increased.
yeah,
So what happens is they get a corresponding increase in their assets,
yeah,
which would be reserves with the central bank. Okay, so now the private bank, and banks essentially have three assets that are they're like a very simple hedge fund, um, and the three assets are loans to you and I and to corporations. Um, they can choose to own treasuries, which are effectively loans to the U.S. government.
yeah,
And then this third thing, which has really come to prominence in the last 15 years, um, more so than the past, which is those reserves with the central bank. So in this instance, the reserves with the central bank have increased, and
yeah,
I believe the hope, the desire of quantitative easing is that the banks kind of look at this asset and they go, yeah, really, and back 15 years ago, the return on a reserve deposit account with the central bank was kind of like nothing.
yeah,
And so the hope is you're diluting their balance sheet, that you're diluting the return on their assets. And so you're hoping that they're either going to buy more treasuries, or even better, the home run is if they extend new credit. So I think
yeah,
of quantitative easing as being latent money printing.
yeah.
You're providing you're effectively providing the alcohol, and saying get drunk on me.
That's
Um,
right.
the great problem, and I wrote a paper on this, um, the I can't even remember what it's called, the awakening of chaos, the dawn of chaos, and I was trying to add to the vernacular of inflation, and Milton Friedman's great contribution. He maintained that inflation is and is everywhere and always a monetary phenomenon, which is to say it's that bank extending the new loan. Uh, I believe it's also a psychological phenomenon, and the
Mm,
psychological phenomenon was that the Citigroups et al. Were um, drunk and hungover
yeah.
post the travails of the crash of '08. And so the Fed comes in with all this alcohol, and they're like, yeah, brother, like,
Hair of the dog. Yeah,
even hair of the dog, but come on, and so, um, have loans grown? Yes. Has it been um, way beyond, if you will, nominal GDP, which might be a frontier to assess and determine just how quickly money is being printed? Not really. And indeed, if you were an alien, if you came in and you didn't know anything about what had passed in the last 20 odd years,
yeah.
you'd find that M2, the wide common definition of bank deposits in the US, I think it's compounded at a rate of 6% per annum since the year 2000.
Right.
Kind of boring, and yet we've had massive, asset bubbles. We've got asset prices or asset ratios to GDP, which are unprecedented.
Yeah.
And so I kind of feel like the answer rests elsewhere.
Okay, well, I wanted to get into that elsewhere, but just to make sure I'm really fully getting this, what you're basically saying is that um, there's a few places where that money could have ended up. It could have ended up to us in the form of loans, in the form of credit, perhaps increased productivity through regional bank lending, something like that. It could end up with the government, could end up with the central bank, but effectively it ended up just doing nothing. It's like latent credit. It's the table was set, but no one was showing up, that sort of thing. And ultimately it's a psychological problem. And I've heard this before, that inflation is it's not just about money supply. That's just really just loading the weapon. It's about the psychology of shooting the weapon. And right now, and probably for a while now, the banks have been, it certainly feels like they've been tightening the screws in terms of their risk appetite. So I guess what you're saying so far makes a lot of sense, that there's very little incentive for the banks to extend credit. Is that right?
Yeah, yeah, no, indeed, that's what I'm saying. There was a metaphor I was using quite a while back, which was it's as though we're living in an igloo. Why an igloo? Because you know the banks have been conservative. It's been, if you will, they've been frigid, cold. They've not been partying, and the igloo is has been doused in paraffin,
Yeah.
and we're really, really damn cold.
Yeah.
But I keep, like you and I keep passing you the lighter. I'm like, you go, you're like, oh, you go, you procrastination, procrastination. So
Yeah.
yeah, um, again, later and later, perhaps, but I have a hypothesis that the country that started quantitative easing in 1990 or so, Japan, the country that's on the 27th iteration. I mean, there's a clue. Look, they've tried
Yeah.
it 27 times, it didn't work, and they keep changing it. Maybe it just doesn't work, What are the chances that the 28th time will work? But if you will, there's a lot of metaphorical gasoline swishing around the Japanese banking igloo. And what if the brothers just went, maybe that's what dollar yen's telling us, but.
Well, yeah. Do you want to unpack that a little bit more? So, effectively, what you're alluding to is that this isn't necessarily a phenomenon that starts and finishes, and the story's fully told in the U.S. This is more of a globalization piece going on. Is that right?
Well, for sure it is. Okay, so let's go global.
Yeah.
I want to kind of again. Uh, so there's a lot of attention given to the dollar reserve currency status,
Mm.
um, but there's never really been a reserve currency. Like sterling, which would be the nearest comparable, the late 19th century. Um, it was its proximity, or it was the confidence that investors had that you could redeem it for commodities. So it was actually we were on a commodity collateral monetary creation system,
Yeah.
and I want to say that today we're not on a gold or silver collateral system, but I believe treasuries have are essentially the collateral,
Right.
and so this is going to allow us to take the leap away from sovereign dollar creation to offshore non-sovereign dollar creation.
Yeah.
And it is simply a fact that if you present a good collateral, what is deemed to be riskless collateral, namely US Treasury bills, and sometimes with a bit of longer tenor, that overseas banks will extend you credit and almost with no haircut. Um,
Right.
and that is money creation.
Outside of the U.S. system.
Yeah. And it goes unrecorded. I guess it gets recorded when when there's a transaction which has an impact on U.S. deposits.
Sure.
But I'd say it's largely unrecorded, and it's largely the factor which has imbued asset price inflation. I think there's, first of all, the Eurodollar system um, is dark and mysterious, and so it lends itself to bodacious presumptions on the macro world. But hey, why not? I did a great show, the Asset Capitalist show last week with Bob Elliott, who
Yeah.
was formerly one of Ray Dalio's kind of gurus, was kind of responsible for the FX bucket there in the all weather fund, and macro is all about um, an awareness, an understanding of previous macro cycles. It's not that many. There's really not that many. You know, I mean,
Right.
if you had an AI model, you could really wrap it quite quickly.
Okay.
Uh, and indeed, Charles Kinderberger, Manias, Panics, and Crisis, is like the Bible of that system.
Right. Okay.
But we were talking about, so we kind of know it. You go looking for trace elements in charts, long term charts, where there's been a disturbance to the price series, and then you kind of fantasize. I mean, I was looking at the British sterling, the cable rate versus the dollar today, and you look at that, and so from a chart perspective, it's just grotesquely bad. You know, it has rallied from almost parity to 130, but there are very clear indications. I mean, FX is all about, it's partly all about charts and trying to draw out the emotions and gut feelings of the traders.
Right.
Um, but there's a clear overhead resistance where it's trading. There's a clear downtrend on it. They're both coinciding, and
Right.
this chart screams at you, "We're going back to parity." Okay, and
Right.
that's just a damn chart interpretation. But then you look at the UK, and and all the Anglo-Saxon satellites orbiting the US have a radically different mortgage market. You know, pretty much everyone gets fixed on mortgages for 2 years,
Right.
um, and that's certainly the case in the UK. It's not the
Right.
case in America. I mean, we're
Mm.
having this remarkably complex period of Fed tightening because um, the private sector fixed everything at like 2% in twenty
Yeah.
twenty,
Yeah.
and
They're
they
immune.
for
Yeah.
30 years, not 2 years, 30 years. And the Fed's
Yeah.
like, is pressing the nuclear bomb, is like, boom, 5% interest rates.
It's not working. Yeah.
Nothing's happening. Like, go
Yeah.
again. Boom, 5.25. Nothing. I don't know. Boom, go again. 5.5. And we're getting to the point where we're like, because you'd expect someone to blow up, and the private sector's like, no problem here, you know. But of course, with the Fitch downgrade, there's always a
Yeah.
problem somewhere. And the weird thing about the US cycle is the most exposed agent is the government. They
Yeah.
they never they never fixed for 30 years. They were issuing the 2 year, and I'm like, you mean we're paying 5%? You mean our interest payments to GDP? We're about to hit $1 trillion. We're 3% of GDP. I'm
Yeah.
like, mad. Like we might have to rein it in a bit. So anyway,
Yeah.
but in the UK, so there we are, and we're looking for. We saw a chart, very long term chart, a chart which just kind of it warns, it's foreboding of kind of not very good things, and then that this mortgage market, Bank of England policy, or Bank of Australia, or over in New Zealand and in Canada, they've been pressing the button and nothing happens, but the 2 year reset means that Jesus, it all happens now.
Totally. Yeah.
So you kind of go looking there.
Yeah.
Um, um, so Eurodollar is one of those places.
Right. So,
And you
but basically, what you're saying is there's this almost like an illegitimate child factory going on in Europe, where these little dollars are spawning themselves, and it's creating these distortions that move around largely unmonitored, and you feel that perhaps explains why we're getting asset price inflation and maybe even consumer inflation. Is that right?
not the consumer, but the asset price
The
inflation.
asset price. Okay.
We've been left with the worst combination of all worlds, which is asset price inflation and wage price disinflation. You see that it's ripping the political economy apart because the real folk, the gap between their income and the assets that they can acquire, like the franchise that they can live under, is getting pulled. It's like a rug being pulled from their feet, so that's not good. The Eurodollar system, I don't like thinking of it as illegitimate. I think it's very legitimate. It's a system without regulation, without
Right.
uh, regulator oversight. I think anything, your regulator oversight just seems to. add complexity and doesn't really seem to solve anything. I'd remind everyone that Credit Suisse this year went essentially bankrupt. It was deemed to be one of those 50 or 60 systemically important banks. It was subject to far greater scrutiny by the regulator.
Sure.
It had more demanding regulatory ratios, if you will. It went bankrupt despite the fact that
Yeah.
it was deemed to be safe on those ratios. So
Yeah.
the Eurodollar system is a system that I like because it's regulated by the confidence of your peer group. That everyone talks. Everyone like they're like,
Sure.
oh,
Right.
that Henry guy, I went lent to him.
So it's
Right?
like the free market is ruling in that space more so, and that's kind of what you're saying, right?
Yeah, and so we saw back in 2008, you had bank spreads begin to widen.
Yeah.
When now we've got this damn so far thing, to trade Eurodollars and short sterling. These were interest rate contracts, which had it was the market's best guess of where rates would be 3 months forward, but it also embedded a credit risk for the counterparty.
Okay.
And and to the Fed's great horror, they cut rates to the floor, but these bank lending ratios were actually going higher, and it was the credit because the banks didn't want to face each other. That was the Eurodollar system. That was banks saying, "Geez, like get me out of here." Um, and it's not, despite its name, it's not Eurocentric in terms of location. Um, Arguably, I think the biggest dollar creating um, metropolitan in the world is Tokyo, the Tokyo
Right.
city center banks, and there is a presumption that I have a presumption rather that they finally went to the Eurodollar, the window, if you will, like the cashier. I mean, think of it as a pawn shop, and you go in, you're like, hey, hold on a second, and like you boom onto the counter. You're like, I got 100 trillion yen, risk free. I mean, negative yielding, Bank of Japan, crazy people, but rock solid, current account surplus. Well, how many dollars would you give me for 100, 100 trillion yen? And you're like, wow, well, we'll give you $1 trillion back. And why it typically goes into asset prices. It's not given to entrepreneurs. It's not influencing wages directly
Mm.
because it's a 24-hour lending cycle. You have to kind of go. They can call you every 24 hours and say, you know what, we're changing the terms. We want to change the collateral. We want whatever. And so it's not the kind of lending or borrowing that you would commit to a 20-year payback. Building a bridge, building another bridge in
Right.
China. That's not what
Yeah.
you're doing. Yeah, you are like speculating. You're putting it into stocks or you're giving it to a hedge fund, etc. It's very liquid, very now.
Got it.
Uh, and I'm just curious that if you look at dollar yen and you look at it on 30, 40-year price ranges, such has been the impulse of the weakness of the yen the last 2 years, that it's beginning to throw up the conjecture, the fantasy of the yen trading at 200, which would be 50% devaluation on where it was 18 months ago, or even 300. And so, my job is to kind of try and work back from these fantastically crazy and scary scenarios, and then kind of say, how could that be? What would the manifestation of that be?
Yeah.
And it might be that the large Chinese banks followed their customers into mainland China. Mainland China was so consensual with its economic growth for the last 15 years. Um, and implicitly, so mainland China is um, always running is structurally short the dollar.
Yeah.
You're an exporter. You receive, or you're an export. Yeah, you're an exporter. You receive dollars. You've
Yeah.
got to hand those dollars back to the state, and you're sitting there with what I call red cabbage. But you want to sell goods overseas again. Maybe you need iron ore, you need oil, you need dollars.
Yeah.
And so there's a whole intricate web of banking offshore, which facilitates you getting those dollars and that commercial trade happening. That's a good thing. And I think the Chinese were aided and abetted by these large Japanese banks. They're sitting at home. No one loves them. No one wants to borrow from them. They're like, let's put it all on the house. And so when you do the conversion in the Eurodollar system, you're taking on a essentially a you're shorting the dollar,
The US
uh,
dollar. Yeah.
US dollar. And so on a kind of 24-hour rolling cycle, I kind of want to say that that short has been called somewhat, and that squeezes the yen and it pushes up the value of the dollar versus others would argue, but others of a more saner, calmer disposition, those that don't wear acid capitalist hats, would tell you that really the kind of 40% devaluation in the yen is more a function of the profound carry. You know that if you're a domestic institution, you can borrow for minus 10 basis points,
Right.
and if you were willing to run an FX position like you could buy US Treasuries today and get 4.05, so you'd be getting 4.15. If you were buying at the 2 year, you'd be getting 5% plus 5.5%, five point
Right.
six percent, um,
Okay.
and they would say once eventually the Fed will narrow that those rates will come down, there'll be a recession, and so the yen will appreciate once more versus the dollar, and we might find ourselves back at around 120, 125.
Okay.
That would be a more orthodox version of where we are, but the fun, the juice, the convexity's in the tail, and tails are more interesting.
Yeah. Yeah. Um, so I kind of want to maybe contextualize this a little bit more, and maybe I should have started this way as well, just by kind of talking a little bit about how hedge funds work and maybe how nowadays how you invest, because what you're describing is you're kind of describing the environment, and then presumably you would be figuring out what kind of positions you would take to benefit from this environment that of course you can't control, it's just going to happen. So can you just walk me through how you would potentially set up your portfolio in light of what you're just talking about, but maybe even factoring in some of the other dynamics at play right now?
Yeah, so I mean, so let's keep to the all weather, um, what I call a kind of quadratic risk expression.
Yeah.
Yes, the diversification of risk. There are points where you step up and you take a lot of risk, but you want to have a coherent, systematic approach to both seeing the opportunities and scaling up the opportunities.
Right.
So if I was running let's call it 100 million NEV portfolio today, the most remarkable thing, the thing that some of your listeners audience wouldn't recognize is I wouldn't really have to spend a dollar
Hmm.
to be represented in markets. So
Okay.
let's go around that. So
Yes, please.
I said like think of a compass point: north, south, west, east, whatever, or God bless you.
Yeah. Yeah. Let's do that one. Yeah.
God bless you for investing with me.
Yeah.
So the first one really would be the S&P. Like you can play around in all the silly stock indices, the DAX, the Nasdaq, whatever, but it's the S&P.
Yeah.
Um, and we're going to think of a risk allocation there. And for most of this year, my allocation has been about 20%. I'd
Okay.
be kind of maybe wanting to pull it back a little bit now, maybe 15. I'd maybe want to be doing um, kind of protective option overriding, because the Nasdaq's up 40%, uh,
Mm.
S&P unweighted is up about 10, unweighted where you have the Amazons and the AI stocks. Again, it's had a
Mm.
fantastic tear, but trending positively. I've got to have an equity allocation. It'd be between 15 and 20% of my NAV. Okay,
Mhm.
um, but I only own it because I feel like I must. I've got to be diversified. It is trending. That's all. There's not. Well, and then you could say that um, you're up trying to short the S&P. You're up against a formidable opponent, which is the 401k program. I
Right.
mean, the S&P just trends. It trends with a Sharpe ratio, which is insanely high which is say without much price variability.
Yeah.
Um,
Yeah.
and then periodically, every 3 years, it just goes boom. It's like a tombstone and it falls over.
Yeah.
Anyway, I'd be there. But intellectually, Um, the thing where I'm seeing, um, I'm, I'm, be, I'm seeing potentially opportunities is in the risk-free U.S. Treasury market,
Yeah.
because
Okay.
sort of risk-free. I mean, it's been downgraded, so how risk-free is it? Um, but there's been a lot of drama. Think of me as Johnny Drama. I like drama,
Yeah.
uh, and in price terms, we've eliminated 15, 16, 17 years of price gains from long duration, long dated US securities. And you can imagine, because of this fear, foreboding of the inflation that we've had and the
Yeah.
expectation that it's going to prove sticky. Sticky is this new term, I
Yeah.
used to eat sticky puddings, but now everyone talks about sticky inflation. It's just
I thought
another.
you were going to say sticky something else, sticky butt or something like that. But we'll go with the pudding. Yeah.
um, Rolling Stones. No, stop it. Right. Okay. The It's had like a three standard deviation price move, negative price movement. And in the world of global macro, you're kind of looking for signals of that nature, two, three standard deviations, price waterfall events.
Right.
The S&P was there in March 2009. They're very uncomfortable places to seek to purchase. There are many reasons you should not be buying, but the best reason is they've had a three standard deviation drawdown, and we live in a monetary system which seems to reward mean reversion. So I kind of feel like um, I don't really buy the sticky inflation. I don't buy the inflation thesis. I don't buy the inflation thesis because we were kind of pointing towards the psychology of the monetary phenomenon necessary to sustain um, inflation. And today, inflation really requires that the global workforce continues to be rewarded with higher and higher rates of compensation.
Right.
And, and so the tailwinds against that would be that you have the gigantic mercantilist nation of China. I say gigantic, it's now the size of Europe. And China just will not tolerate um, the wages of its domestic labor pool matching those of productivity. So labor is always structurally cheap in China. It's one of the structural kind of parts of their system which favors exports and profoundly large trade surpluses. Trade surpluses which are three times greater than anything you see from the 19th century. I mean, truly remarkably high. So that's really hard. It's really hard if you're in Australia or Europe, the United States, and across industry you are you're raising the price of labor. Labor's going to disappear. It's just
Right.
you're just going to facilitate this. Now you could say, well, yeah, but we're now doing onshoring. We're doing a little bit of it, but onshoring would take you 30 years. So, and then they say, well, it's marginal rate of change. Anyway, for me, I don't see enough risk seeking behavior from banks, and I don't see the Chinese authorities changing their practice with regard to their labor pool or indeed their currency. Their currency is proving a little bit weak, and that just adds to the pressure on Western labor markets. So
Yeah.
for me, the inflation is, we had a pandemic and we closed everything down. We sent people checks. Demand was greater than supply. Prices went up, and it's taking about 2 years to work its way out of the system. As it does, you can see you're just kind of seeing forward prices
Yeah.
via producer prices. Producer prices are collapsing. They're collapsing. So that would be my bet. So
Yeah.
I, I'm not an inflationist. Prices have fallen dramatically. Um, but I can't buy them because I need the legitimacy of a price trend. And so
Right.
I got to squiggle a little bit, and I come in and I buy options. I buy um, various options, but I basically I buy um, the TLT, which is an
Right.
ETF. It's 17-year duration treasury bonds.
Yeah.
I can buy options on it expiring in January of 2025. I
Yeah.
started buying them this year in March.
Yeah.
Um, I've only lost money since March.
Yeah.
But think of the terms involved. So, what did I say? I had 100 million hedge fund. I've got 20 million in the S&P stroke Nasdaq. Um, and here we're talking about putting um, 7 million in option premium. So
Right.
it's considerable.
And
But it's,
you're talking about call options specifically, right? On the TLT.
oh yeah, I mean the so I'm kind of close to the money.
Yeah.
Um, the TLT price was I want to say 96, 97. My head spins. It's
Yeah.
come down from 100.
Yeah.
Um, and the folks that follow me on Twitter are like, "Oh, this has been a terrible trade." I'm like, "Dude, it's August of 23. Okay, I've only
Yeah.
had them on for 4 months. It's like, shh, macro's really slow. It
Yeah.
takes a long. The U.S. economy is $25 trillion. It takes a long time for it. If it's losing its mojo, it takes a while. And
Yeah.
that's an important thing with macro. We're not traders. We're not. Oh, we'll make money in July. We'll make money in August. It's like I've got a landing strip which is 2 years,
Yeah,
and
that's surprising for me because I kind of always assumed it would be always short term, always in the now, high frequency sort of stuff. But talking about a 2 year time frame like this, kind of goes counter to that. That's for sure.
yeah, I mean, and um, it's mostly like that. In 2008, I enjoyed a good year. I made 33%. I made 50 in the month of October 2008, but that all stemmed from a position that I had committed to in in May of 2007.
Okay.
Takes
Okay.
a long time to bear fruit.
Yeah.
And you've got to survive just the craziness of markets.
Yeah.
Lehman Brothers went bankrupt, and 2 weeks prior to that, the the share price series of U.S. banks made an all-time high. You can't make that stuff up. So
Yeah.
anyway,
Yeah.
so I've got 200,000, let's say, in 200. Sorry, I've got 20 million in S&P. I've got 7 million in treasury bond futures. And
Yeah.
I have to say, just in terms of education and stuff, it's not good just to buy call options or just to buy put options.
Mm.
Any option is overvalued, and like really richly overvalued. Really
Yeah.
richly overvalued. I
The
mean,
house has to always win. Yeah.
yeah, the richest people in the world are uh, the people who write you the options.
Yeah.
And so when I say I've got these 100 strike calls, that's true. But in the short term, I'm writing a lot of calls and puts. So I'm trying to do something about the old, like I'm trying to cheapen the cost
The
of my
cost of it.
option,
I hear you.
and
Okay.
and I can cheapen it because again, I'm kind of, if you will, willing to forgo. I don't think my strategy is going to like explode to the upside this month. So short dated. So if you will, I'm committed, and I own expensive, overvalued, long dated options,
Yeah.
and I try and cheapen it by selling both calls and puts depending on where we are.
Sure.
If we're trading 102, then I'm selling 102 calls. If we're trading 98, then I'm selling 98, 96 puts. But
Right.
anyway.
Okay.
Um, Next quadrant would be alternative assets, and that's where you find gold,
Yeah.
Bitcoin, commodities, real estate, private equity. That's $100 trillion quadrant. Um,
Yeah.
I'd have to have about 5 million in gold futures.
Okay.
Um, yeah, gold has been hereabouts for the last 12 years. It's at a kind of barrier of just above 2,000. Um, Macro is all about barriers, price levels. Um, Kind of going sideways for like a decade, 2 decades. But
Mm.
when the price breaks them, boom, they go higher.
Yeah.
So um, I've got 5% in gold because of everything that's going on.
Yeah.
Um, they are issuing more of those treasuries. That Fitch is saying that this is not good.
Yeah.
The I think we're going to see a big slowdown in the economy. What do they do next, kind of thing. So, gold is a bit of an insurance policy. And secondly, gold the gold's typically expensive because um, you're getting paid interest, and again, you're getting paid 5.5% by the Fed, you get paid nothing in gold.
Yeah. Yeah.
But on the other hand, um, asset prices are kind of the level of asset prices suggests that the 10-year expected return on equities is zero at best.
Huh.
So actually, gold's not that scary, It's like, well, yeah. Anyway, so I'd have five in
Yeah.
gold. I'd
Okay.
gold is something I'd want to layer into. I want to buy another five at higher and higher prices.
Okay. Okay.
Uh, I don't think it can trade much beyond 3,000 because of the starting point.
Sure.
I mean,
But
you could,
largely that's an insurance strategy more than hoping to get a good gain. You've just got an analog version of, hey, if everything goes to hell in a handcart, this will pay out. Is
yeah,
that
and
right?
again, it's recognition of very long-term price charts, and the very
Right.
long-term price chart says, push come to shove, you got to have something here in case it breaks the barrier. Asset classes which break barriers and trade higher can have explosive movements. So gold ticks that box, but I'd have a much bigger position in Bitcoin.
Okay.
Yeah,
Tell me about that.
I
Yeah.
would have like 20 million there, um, and the reason is it's just preposterously small. I
Yeah.
mean, first of all, like gold is preposterous, right? I mean, what is gold? Is it something that came from a meteorite? People go wax lyrically, but you know that there is someone somewhere in the world that's always willing to pay you quite a lot of money for the yellow metal, um,
Yeah.
and kind of we don't have thousands of years of data, but it looks as though Bitcoin's going to be the same.
Yeah. That's right. Yeah, well done. Hey, just on that, Hugh, like there obviously I'm guessing there like many people in your space, there would have been a point in time where you weren't on board with Bitcoin. Maybe you didn't understand the thesis or you just needed to see a longer time frame or you need to see the market cap grow. But what was it that caused you to kind of flip the switch on Bitcoin just while we're on that topic?
Yes, so again, it's kind of having this quadratic impression of asset allocation,
Yeah.
um, being in it to win it. Yeah, the fact that asset classes are so rich across the world. The fact that Bitcoin had another mean reversion. It did fall from 70,000, and it came all the way down to what 17 or so thousand,
Yeah, that's
eighteen
right.
thousand.
Yeah.
So that's mean reversion. Um, and then the sheer the total market valuation of Bitcoin, it's only I don't really include crypto in my world.
Good. Yeah.
I'm less interested.
Good man.
Bitcoin, the market value is about $500 billion,
Yeah.
so it's 1/26 the size of gold, um, and I still believe crazy things do happen, will happen,
Yeah.
probably will happen even more, and so I want to say it has convexity. I mean, Bitcoin could trade 4x higher, and it really wouldn't have a ripple or an impulse onto the. It wouldn't have an impact onto other asset classes. If
Yeah.
gold is $13 trillion, if gold triples, it's bigger than all
Yeah.
U.S. stock indices. So
Yeah.
that's kind of I'm like, it's going to, I like gold, but really it's going to be bigger than all equities. Whereas if that happens to Bitcoin, then what it would be one and a half
Mm.
billion dollars, be the same size as Meta, Facebook. Like yeah, okay,
Mm.
why
So
not?
better reward for the same potential catalyst. Like if we equate gold and Bitcoin, similar in terms of their use case as a diversifier, I guess you could say, right?
Yeah, and again, this is all coming against the backdrop that, you know, we invented a financial system which used treasury bonds as collateral,
Yeah.
and the U.S. government now is printing a lot more of those collateral treasury bonds.
Yeah.
Uh, and so that system may be on the throes of becoming inflationary. Um, you know, I take issue with people who say it's now. I think it's close, but the bit between it's a bit like on options. You also have this dead zone before you make a lot of money, and I think we're entering into the kind of drop dead zone,
Okay.
and then you get your inflation. So whatever.
Yeah.
Um,
Okay.
so they have relevance. They are alternative currency assets, if you will. Bitcoin is the smallest. It seems to have demonstrated proof of concept, and then finally, it's woken up the greedy denizens of Wall Street. The guys who like Wall Street is a machine. It makes money because, oh, it's not a machine. It's a casino, right?
Yeah.
And there's a lot of casino owners that are like, let's do Bitcoin, like so.
Yeah.
What I'm talking about, we now have a Bitcoin future. We're It looks like we're going to have ETFs,
Yeah.
and together they will, and they're being supported by the most gigantic financial behemoths, and they employ thousands of people, and they're going to be on the phone with hundreds of thousands of people, and it's going to become a kind of George Soros reflexive system. So, there, I say to you that I would buy in clips. I'd buy more Bitcoin going down. So I'm saying to you, um, my treasuries, they're trading kind of 100, and as they trade closer to 90, I'm a buyer.
Yeah.
My Nasdaq, I only own it. I only own it because it's going up.
Yeah.
I think it's overvalued, but it's going up, and I respect uptrends. If it loses its uptrend, I'm like, get me out of Dodge City. I'm a seller.
Yeah.
Gold, I said to you, I'm a buyer on incremental leaps higher.
Yes.
Bitcoin, I'm a buyer on incremental um, latches downwards.
Yes.
I'd want to, if it was going to trade 10,000, I'd want to maximize my position. If I'm starting at 200,000, I would want to think that I could be at 400. If I was starting at 20 million, I'd want to be 40 million if it traded as
Okay.
low as 10,000. And
Okay.
then finally, we've got a final quadrant, which is cash.
Yeah.
And all of those transactions, they haven't really cost me any money because I bought futures.
Right. 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 Okay.
So again, if I'm a hedge fund, I'm still sitting with $100 million. Actually, I've I probably I, I've probably posted 2 or 3 million for the treasury call positions. So I'm sitting with 98 million in cash, and I'm getting 5.5%.
Yeah.
So so for hedge funds and stuff like this year's kind of pretty okay.
Yeah.
You're not trying. Macro's not trying to beat the beta of the S&P or the Nasdaq, and you're starting a year where you get like 5%, like positive on your cash. Like, hey, this is cool.
Yeah, it's pretty cool. Like it's something that I think like for myself and for the people that I talk to, it feels kind of like everyday investors are told to dollar cost average into a very well diversified fund and just to sit tight and shut up. And no disrespect to that whole industry because I'm in that, but I think when it comes to looking at this from a macro framework, I'm just wondering why is it that everyday investors don't kind of play the investing game using a similar sort of framework that you've just described? And like why do you think that is?
Oh, because you get sold financial products, no one buys them. Some guy phones you like, "Hey, hi, George, do you remember me? We had a drink at the golf club." And plus everyone's busy, and it's a little bit scary. They use all these terms, you know. People think the central bank's like a genius. They're idiots, but and so yeah, I mean, my business is, if you will, I'm a financial influencer these days. I'm seeking to socially influence people to try and wake them up and say, you can kind of do it. You can
Yeah.
you can
Well,
do
tell
this.
me about that, Hugh. Like, what are you doing at the moment in that space? Because like I say, I know from your hat, you're the acid capitalist. But tell me a little bit more about what you're up to.
Yeah. Well, I mean, yeah. I mean, as you know, I was a global macro hedge fund manager. I had my own business out of London. I ran a hedge fund for 15 years. My engagement with the sector started 25 years ago. So, I've got a lot of experience. Um, Hedge funds became over-regulated. I'm passionate. Hedge fund or investing is just a wonderful thing for curious minds. I mean, I'm like curious all the time. I keep asking questions, and questions make, I don't know, prizes in the world of speculation. But
Yeah.
it became, I lost it was joyless. I had passion, but it was joyless. I invested. I'm here in St. Bart's, and I invested in the local property market, and I saw very similar characteristics to Bitcoin. Um, it's scarce. They have a kind of almost, they have a halving concept where
Huh.
the supply get, I mean, literally here the supply does diminish because the permits that they issue, they're not issuing, and so the existing stock becomes more sought after.
Right.
Um, and there was like, there's a your clients pay you in dollars, your expenses are in euros. I was looking to borrow from French banks over 20 years at 2%. And I there's a view of the world, a view where Bitcoin trades at $150,000 or gold trades at $4,500. That's a
Yeah.
world where the shareholders of the bank have transferred their wealth to me via the mechanism of the mortgage. It's a
Yeah. Yeah.
leveraging real assets. Um,
Yeah.
and then um, I've got this calling again. I still hear these voices in my head,
Good.
and so I've got a Patreon account. I'm doing a weekly podcast with people that make me think. um,
Yeah.
Patreon, I get people can get a one-on-one mentoring scheme with me. It's amazing the stories that I hear, um, and the journeys that they take me on. I'm about to
Yeah.
host a summer camp here in St. Bart's for a
Yeah.
lucky few. They're going to stay in my properties here.
That's great.
I sell these hats, and who knows what else. I should really be managing money again. That's where the money is, baby.
Yeah. Well, maybe this is the next manifestation of how we all should be doing it, Hugh. Who knows? Hey,
But it can.
there's
We can all do it this way. We can all do it
Yeah,
this way.
yeah. There is just one more question before we go that I'd really love to pick your brains on because it's something I think a lot about. I'm quite into property myself, and to understand where property values go, kind of need to understand where interest rates are going to go, kind of like bonds, I guess. And that leads you on a little bit of a chase, and you kind of have to hunt down some of the things that move interest rates around, not just here in New Zealand where I'm living now, but worldwide because everything increasingly seems to be connected. So from your perspective, and I vaguely kind of understand how this works, but maybe if you could explain it, just with Japan and China unloading more treasuries potentially, can you talk to me about how that might influence interest rates, or if there's anything else that you can pick on that might influence interest rates, say in the next 1 to 2 years?
Sure. I think that's the best, most complex way to close the show.
Good stuff.
Damn. The we have to be cognizant of how exceptional this rate hiking period has been
Yeah,
within America, because the private sector has been immunized. It has not felt these higher rates, yeah,
yeah,
which is why the economy just has not pulled back. We haven't had a recession. It's been the sharpest, fastest tightening of policy in 25 years. And if you will, Atlas shrugged. Market went, okay. Um,
mm,
but
yeah,
there are consequences. And to answer your question, um, no one, this is a very US centric answer, but no one can afford to move house. If you move house, then
hmm,
you have to cancel your existing mortgage, struck at 2%, and take on a new mortgage. And I saw figures that if you take on a new mortgage and you buy the average house, if you will, the average house price transaction, and you take a new car loan for the average car loan, and so you reset higher to where, if you will, Fed rates plus risk premium are. Um, two-thirds of your income, two-thirds of your disposable income, are swallowed up by your house and your car.
yeah.
And of
Crazy.
course, insurance is very expensive. In health insurance is very expensive in America. You've got to feed yourself. God help you. You've got kids and education and all that as well. So,
Yeah,
so I feel like just now the U.S. is subject to kind of slow form of asphyxiation. It's
mm,
like it's just gently slowing down. I mean, at some point, people have to buy cars and they have to move house. You got to move state. You get a new
yeah, yeah.
job.
Well,
Things
it's kind of
change.
like they're holding their breath, right?
They're holding their breath, the asphyxiation. Yeah.
Yeah,
So, and at the same time, um, the federal government, you've had a very surprise slowdown in federal tax receipts. Partly because asset markets were so strong 18 months ago, and the anniversary that's rolling off, but it's really caught them out. Deficits are actually going up as a percentage of GDP, and the economy has not had a recession. And so people are like, yeah, and their interest payments now are on the verge of usurping what they would traditionally spend in sensitive sectors such as defense. So again, you've got a sector, you've got the private sector, which is kind of okay, but it's kind of losing oxygen. And then
Yeah.
you've got the public sector, which really has some serious thinking to do about retrenching and perhaps spending less. So
Yeah.
I think a slowdown will come in the US. At the same time, you've got a huge amount of financial institutions, and they borrow short and they lend long. And because you had like zero real, sorry, you had very, very low long term interest rates for 15 years,
Yeah.
you've got a huge legacy of mortgage and other corporate debt, which
Yeah.
now has to trade way below NAV or par because it was struck at the wrong price. So this,
Yeah.
if you will, this hidden instability in the financial sector. So I'm not
Yeah.
convinced we've seen the last, financial accident. And of course, the the manifestation of that is weak credit growth and a lack of risk appetite everywhere outside the stock market. So US is like amber, and then in terms of housing, where you are in Australia, Canada, and the UK, I think you've got to be anticipating um, you know, a serious pullback in house prices.
Yeah.
You know,
Yeah.
you've had a generation of people that did the buy to let. Buy to let does not work
From a
at
yield
today's
perspective.
yeah,
Yeah,
yeah.
that's right.
Um, and
Yeah.
and and it doesn't work if you're renting it, and so it means that a lot of properties are coming on the market to be sold. And again, who's going to buy it because rates are really high? So
Yeah, yeah, yeah. So it's all kind of pointing to the same thing: higher rates, potentially less credit growth. Um, there's little incentive for people to move on. So I guess it's a question of how long can everything. It's not just people, but how long can everything in the system hold its breath for while we maintain this high interest rate setting. So I guess what is the ultimate cure then? Like where do we need to be for stability to come back and for normalcy to reign again?
that's part that's part two,
That's
because
part two.
we haven't really mentioned, we mentioned in passing China, but um, the rest of the world, these very large export dominated economic blocs, um, they have currencies which depreciate against the US dollar. They run persistent surpluses. Um, it would be good if their currencies were rising, their consumers were becoming richer, and
Mm,
they were buying goods and services. So the world is that's not happening. There's a profound structural deficit in demand for goods and services,
yeah.
because the rest of the world should have currencies which are stronger vis-a-vis the US dollar, but they don't. And they don't
Got it.
because um, the US buys their goods and services, so it, it addresses their overcapacity issue. And in return, people like China, because you said, what if China and Japan sell treasury bonds? They won't.
Right.
Yeah, if they sell treasury, I wish they would. I would ban them, but I wish they would, because
Yeah.
it's the every year it's the avalanche of buying treasury and other US dollar risk
Yeah.
free securities, which keeps the dollar strong vis a vis them. So they buy financial
Mm,
assets. So the true cause in my head of the asset price inflation is the organization of international trade. And
yeah.
so
Yeah.
ultimately, I think we're just in in a rinse and repeat cycle where the system needs more and more debt. Presently, the cost of the debt has been set, I think, too high. We've talked about asphyxiation.
Yeah.
Um, I think the cost of debt will have to come down. Fed and other central banks will cut rates. That will facilitate more debt accumulation
Yeah.
and therefore more economic growth, but
Yeah.
more economic volatility, and and that's to be determined what happens
What
next.
happens next? Yeah, but ultimately, if other currencies can appreciate in value, maybe there's wage inflation in developing countries, and maybe that wealth gets spread more evenly rather than I'm going to lose this bit so I can gain that bit.
Absolutely. I mean, I would much rather trade future wage inflation for the household sector to try
Yeah.
and do away with this grotesque income inequality. I would
Yeah.
trade that for higher asset prices.
Yeah.
Uh,
Yeah. Yeah. I think everybody
but
would. Yeah.
the people who write the big checks for the politicians,
Yeah.
are the asset guys and girls. And they're like, no, 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 no. Give me
Yeah.
hawkish central banking, So um,
Yeah.
we're going to have to burn the whole thing down before I think, we get any chance of, we've got too
Yeah.
many people disenfranchised.
Yeah.
And you
Yeah.
can see politics are just becoming kind of really, really
Yeah.
complicated.
Well, it's like when the music's over, turn on the lights, right? It feels pretty close to that, doesn't it?
Well, let's keep on Jim Morrison. What have we done to our fair sister? We've ravaged and we've pillaged her. It's time
Yeah.
to take care of our sister and start doing proper
Yeah.
things. But it's
Yeah.
the problem. It's a little bit. Professor Michael Pettis, one of the, the, the greatest minds on current international trade policy and
Yeah.
other matters. Um, China's in this terrible dilemma because the 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 internal policies that have been responsible for taking it from less than the size of Turkey to greater than the continent of Europe, those policies don't work anymore.
Right.
But they rewarded lots of vested interests. And to get everyone aligned and say, look, we're going to change this, the
Yeah.
reward,
Right.
the reward system is going to change. It's going to be good for the nation, but I'm afraid, Wang Hu over here, like, yeah,
Yeah.
you've made enough. And Wang Hu's like, oh, not me,
Yeah.
you know.
Yeah. It's a tough.
So,
It's a tough sell. Okay.
very tough.
Well, maybe that is part two, Hugh. We'll dig into that more another time. But I really wanted to thank you again. Thank you very much for speaking with me. And for people that want to follow you on Twitter, or not Twitter, X, how can they find you there?
Yeah, X marks the spot. Hendry underscore Hugh. Um,
Awesome.
and the Asset Capitalist Show on YouTube and on the podcasts, podcast
Fantastic.
platforms.
Awesome. All right. Thank you again, Hugh. Enjoy the rest of your day there in St. Bart's.
Thank you. Take care. I
All right.
enjoyed it. Good stuff.
Take care. Thank you. Same here.